Sometimes the biggest shifts in history don't begin with loud announcements, but with quiet cracks that suddenly become impossible to ignore. And right now we are living through one of those moments. I've spent most of my adult life watching how real power works beneath the surface, not in slogans or speeches, but in the way decisions move through systems, industries, and agreements that most people never think about until the system stops working. What is unfolding across the United States supply chain today is exactly that kind of turning point, the kind historians later circle and say, this is where consequences caught up. For years, Washington treated its closest neighbor as if pressure would always be tolerated, as if Canada were just another opponent in a political contest, rather than a partner woven directly into the structure of the American economy. But Canada made a decision that cut straight into the physical backbone of that structure, and the effects are now spreading through factories, energy networks, construction projects, and corporate planning rooms in a way that spin cannot hide. This isn't one of those disputes that can be fixed with a quick statement or a change in tone at a press conference. It is the point where political theatrics collided with economic reality, and that collision is unfolding faster than many in government thought possible. For more than 7 decades, the United States and Canada built what is arguably the world's most deeply connected economic relationship, not because of romantic ideas about partnership, but because it worked. North America gradually became a single production system in which raw materials, parts, and finished products moved back and forth with almost automatic regularity, crossing borders multiple times before ever reaching a customer. The strength of that system came from something very simple: predictability. The rules didn't lurch with every election or every angry moment in politics, and companies could plan far into the future on the assumption that stability would hold. Over the past year, that assumption has been methodically eroded as Donald Trump returned to power with a worldview that treats trade less like cooperation and more like combat, where symbolism and displays of dominance matter more than long-term outcomes. That outlook eventually hit a limit when Canada received an ultimatum no independent country could accept without giving up control of its economic destiny. The trigger wasn't some technical misunderstanding or small legal disagreement. It was presented as a final demand that Canada restrict exports of key materials unless American companies were allowed access at reduced prices. The significance of that demand is hard to overstate because it wasn't aimed at solving shortages or stabilizing markets. It was designed to force another country to sell its own resources at a loss simply to support a political story at home. When Canadian leaders examined that demand, they knew instantly that agreeing to it would not just hurt economically, it would redefine their sovereignty. It would create a precedent that any future administration in Washington could override Canadian decision-making whenever pressure was politically convenient. That was the line Canada chose not to cross. What followed didn't look like the dramatic retaliation people imagine when they hear about trade wars. There were no sweeping tariffs announced overnight or fiery speeches about revenge. Instead, Canada took a quieter, more consequential step. It withdrew from voluntary supply chain coordination mechanisms that function only when both sides assume reasonable behavior and mutual trust. By stepping back, Canada revealed how vulnerable the U.S. production system had become after decades of just-in-time practices built on the belief that parts would always arrive exactly when needed. Within hours of that move, stress signals began flashing through the economy, showing how quickly the absence of trust turns into disruption. Almost immediately after Canada's decision, the abstract idea of supply chain risk turned into concrete problems on the ground. Auto plants in states like Michigan and Ohio received notices that key components would no longer arrive on schedule. The shipments weren't formally cancelled or outlawed. They were simply delayed without clear timelines, which in a tightly synchronized production system is almost the same as shutting down. When inventory buffers don't exist, even a short delay can halt entire assembly lines. Construction companies soon discovered that the Canadian steel and lumber they had assumed would clear the border on predictable schedules were now subject to uncertainty, throwing project timelines and contracts into confusion. Energy traders reacted instantly because they understood what many politicians did not. When guaranteed flows of Canadian oil and natural gas stop being guaranteed, price models no longer work. Markets that depend on stability above everything else suddenly had to factor in unpredictability. This is where the administration's core miscalculation becomes obvious. Size alone does not equal control in an integrated supply network. In systems where production is spread across borders, the country that provides essential inputs often has more practical influence than the larger end market. Canada occupies exactly those strategic positions for energy resources, critical minerals, automotive parts, and building materials that American industries cannot easily replace. The idea that these inputs could be substituted quickly ignores how long it takes to build new capacity, create new transport routes, and secure regulatory approval. For many of these materials, alternatives are measured not in weeks or months, but in years and enormous investment costs. Yet the ultimatum to Canada was delivered as if it had no meaningful options, as if differing GDP figures automatically guaranteed compliance. That assumption collided with the reality that modern manufacturing is a delicate coordination of thousands of parts and processes, and removing a single link can stall the whole chain. As delays spread, an unusual change occurred within corporate America. Leaders who had remained quiet during earlier trade disputes began urgently contacting lawmakers and administration officials. Their message wasn't ideological, it was operational. They explained that facilities would run out of inputs within days, workers would be sent home, and foreign competitors, especially in Europe and Asia, would seize market share, while US firms struggled with self-created disruptions. These were not theoretical warnings. They came with charts, production schedules, and inventory levels that showed how narrow the margin for error had become. Major business organizations issued emergency statements. Industry groups published forecasts projecting massive job losses within weeks if the situation persisted. Suddenly, the consequences of turning trade into a stage performance, focused on appearance rather than structure, became impossible to wave away. The thing about factories is that they don't respond to speeches. When production stops, there is no slogan that restarts it. When employees are told not to come in, political branding doesn't cover their rent or groceries. When energy prices rise because supply certainty evaporates, households notice immediately. What makes the present situation especially risky is that it fits a pattern that has appeared before, where bold threats are made without a realistic exit plan. Past examples include tariffs on China that ended with large subsidies to American farmers and near crises at the Mexican border that rattled industries until pressure from businesses forced policy reversals. But Canada's case is different. The economic integration is deeper, the reliance more complete, and the willingness to accept pressure far lower. That combination creates a crisis not easily softened by rhetoric or symbolic concessions. As the disruption intensified, the political consequences began to surface in Washington. The administration's own coalition started to feel the strain as the economic impact spread from theory into daily reality. Republican senators from heavily affected states publicly demanded a resolution, warning that local industries were at risk. Labor unions, representing workers on factory floors, cautioned that layoffs were imminent if supplies did not normalize. Business leaders who had once praised Trump's hardline approach to trade slowly stepped back, not because their principles changed overnight, but because the financial damage was undeniable. Their companies were losing money, their operations were stalling, and investors were responding to instability rather than strength. This is the point where displays of toughness collide with the responsibility of governing, where image is suddenly tested by outcomes that cannot be edited or reframed. The deeper issue, one that will linger even after the immediate conflict is resolved, is the message Canada's response sent around the world. It signaled to every American ally that economic integration with the United States now carries political risk that cannot be fully managed through diplomacy or contracts. Once partners see that established arrangements can be turned into leverage for short-term political gain, they begin recalculating. Governments diversify trade relationships. Companies redesign supply networks. Investments shift toward countries seen as stable and predictable. The realization spreads that the United States, once considered the anchor of reliability, may no longer always play that role. Reliability is the hidden foundation of power in the global system, and when it erodes, the effects ripple outward quietly but decisively. What we are witnessing is not simply a disagreement between two governments. It is the exposure of a structural vulnerability that has always existed beneath the surface, the vulnerability of an economy that assumed cooperation would continue automatically, even while electing leaders openly skeptical of that cooperation. Now the contradiction between reliance and hostility is collapsing in real time. The consequences are arriving faster than expected, reshaping plans across North America in ways that will not be easy to undo. Once trust turns into contingency planning, the old normal rarely returns. Systems adjust to protect themselves, and those adjustments often become permanent. The shock of this moment is particularly unsettling for Washington because there is no easy exit from it. There is no solution that restores the previous situation without admitting strategic misjudgment. The entire strategy rested on the assumption that Canada would eventually yield, that differences in economic size alone would force compliance. When that belief fell apart, it revealed how little backup planning existed beneath the rhetoric. The administration now faces two choices, both politically costly. It can escalate, increasing tariffs and tightening pressure, which would intensify the supply chain damage and deepen job losses. Or it can retreat and search for compromise, which would contradict its own image of never backing down. Either path carries visible consequences that will be impossible to hide from the public as factories slow, energy prices shift, and projects stall across the country. If Trump chooses escalation, the effects become even more severe. Comprehensive tariffs and tougher restrictions would accelerate the disruptions already underway. Facilities that are barely staying open would close outright. Layoffs would move beyond manufacturing into sectors like energy, logistics, and construction. Costs would climb further, reaching consumers in the form of higher prices and fewer job opportunities. At that point, the argument that the crisis is only a temporary negotiating tactic would be impossible to maintain, because people feel real consequences directly. When factories go dark and projects stop midway, it is no longer an abstract policy debate. Communities see the results, and those realities cannot be erased by rally speeches or press statements. Yet, if the administration attempts to de-escalate, to quietly soften its position or negotiate a compromise, it faces a different challenge entirely. Trump's political identity rests heavily on the idea that he never retreats, that threats always produce results. Any visible concession would be presented by critics and perhaps eventually by supporters as proof that the approach failed when confronted by a determined partner defending its independence. That is why the damage now reaches beyond economics and into credibility. Allies across the world are not paying attention to slogans, they are watching outcomes. They want to know whether the United States can participate in deeply integrated economic systems without turning that integration into a weapon. They are asking whether American leadership understands the difference between leverage that strengthens alliances and pressure that harms its own economy. Meanwhile, inside Washington, the institutional strain is becoming clearer. Trade specialists who had warned that such brinkmanship carried high risk are now being proven correct in real time. Legislators who were not directly responsible for the policy find themselves having to defend or explain it, even as consequences multiply. The imbalance in the political system also comes into focus, how a single executive decision can trigger nationwide disruption before courts or Congress have any practical opportunity to respond, because legal processes move slowly, while supply chains react instantly. Canada, intentionally or not, shifted the debate from theory into everyday logistics. By stepping back from coordination agreements, it forced the issue into the real economy, where trucks, pipelines, and production schedules determine what happens next. Once a crisis reaches that level, it cannot be contained inside talking points. Trucks that don't cross borders do not respond to speeches. Energy flows don't adjust themselves to fit narratives. Assembly lines do not wait for political storylines to be rewritten. Perhaps the most long-lasting effect of this confrontation will not be what unfolds this month, but what happens afterward, quietly and steadily, as American companies rethink how exposed they are to political volatility. They will begin sourcing parts from multiple regions, even when it is more expensive. They will invest in redundancy, instead of assuming efficiency alone is safe. They will direct investment toward countries where policy changes are less abrupt and less personalized. Once those decisions are made and money is committed, they rarely reverse. And the integrated North American economy that took generations to build begins to fragment piece by piece, not through dramatic collapse, but through countless small adjustments. Canada understands this dynamic clearly. That is why it is not simply waiting for Washington to realign its strategy, but is accelerating efforts to widen its trade links, expand relationships with Europe and Asia, and ensure that future American ultimatums cannot threaten its core economic stability. The lesson learned is practical. Dependence on a partner that treats interdependence as pressure is itself a weakness that must be reduced. Other allies are drawing similar conclusions, realizing that if the United States is prepared to issue harsh demands to its closest neighbor, one with shared values, and the world's longest peaceful border, then no partner should assume immunity from comparable treatment. Those assessments will influence foreign policy and economic planning for years ahead. The most striking aspect of this crisis is that none of it had to happen. The supply chains holding the North American economy together did not fracture because of earthquakes, pandemics, or unavoidable catastrophe. They faltered because political theater was elevated above careful management, because complex systems were dismissed as weakness, and because displays of dominance were valued more than the quiet responsibility required to sustain prosperity. The people now bearing the brunt of the disruption are not the architects of the strategy. They are workers sent home from idle plants, small businesses unable to secure vital materials, families facing higher energy bills, and communities watching decades of economic integration unravel despite having done nothing wrong. The decision makers most responsible remain largely shielded from the immediate fallout. And that gap between those who decide and those who pay is precisely what erodes faith in democratic accountability. When power can inflict broad economic harm without quick consequences for its authors, trust weakens not only between nations, but within the nation itself. As events continue to unfold, the central question for the United States is no longer whether Canada can be pushed back to the table under pressure. The real question is whether the United States can relearn the discipline required to use its influence with restraint in an interdependent world where leverage cuts both ways. Strength without self-control easily becomes self-inflicted damage, and unpredictability presented as toughness eventually drives partners to look elsewhere. By refusing the ultimatum, Canada didn't simply object to a single policy. It revealed a deeper truth. Sovereignty still matters, trust has limits, and even the largest economies cannot coerce their way through systems they depend on and help design. That lesson will not fade when the immediate headlines change. Once partners recognize that reliability can no longer be assumed, they behave differently, quietly, steadily, and permanently. The consequences of this moment will live on in redesigned supply chains, revised diplomatic strategies, and recalculated alliances across the world, long after the speeches end and attention shifts, because once a truth like this becomes visible, it does not disappear when the news cycle moves on.